Hello. In this video, we'll be going through expense-related deferred tax liabilities. In our Introduction to Accounting for Income Taxes video, we talked about the differences between what you see in income statement for financial reporting purposes versus a tax return for tax return purposes. Every company has to file a tax return and they need to calculate their taxable income, while some of the revenue and expense items between what's reported for financial reporting and taxes may be different. One of the type of item that may be different is called a temporary difference, and that arises when the tax rules and the accounting rules recognize the income, or it should say, or expenses in different periods of time. So it's not a issue of whether an amount is taxable or deductible, but just when the deduction or revenue, the revenue or expense is taken in a different period than it is for tax purposes. So we have this account called deferred tax liabilities, which arises when activities, and when it says activities, it means either revenue or expenses reported in the current period's income statement will produce future taxable amounts. So we don't recognize as much income or recognize more expense in the current period on our tax return, and therefore we recognize more on our tax return than we do for financial reporting, and therefore it will result in future taxable amounts. On the flip side, we have deferred tax assets, which are activities, the revenue and expenses that are reported in the current period's income statement will produce future deductible amounts. So we recognize more revenue or less expense in the current period for tax purposes, and that will result in a future deductible amount, and we record an asset, a deferred tax asset for that. And when we record a deferred tax asset and deferred tax liability, the other side of that journal entry goes to income tax expense account, which is reported on your income statement. So the income tax expense is considered to be a plug in the journal entry when you record your current tax payable as well as your changes in your deferred tax asset and deferred tax liabilities. And we use a four-step process to do this. First, you calculate your tax payable, and I like to call it income tax payable. And this is the amount of tax that is currently due on your current year tax return. So when you look at your revenue for taxes, expenses for taxes, which are called deductions, then you have taxable income times a tax rate will give you your tax payable, your current income tax payable amount. So this is how we do income tax accounting. We calculate the income tax payable. We're going to calculate our ending deferred tax assets and deferred tax liabilities, which are labeled as DTAs and DTLs. And then when we calculate the differences, we take the change between our beginning balance of our asset or liabilities and the end, and the difference is what gets recorded in the current period. And then we have a plug to the tax expense. So we calculate our tax payable, and then we're going to calculate our change in our DTAs or DTLs, and then whatever it takes to make the journal entry balance, we're going to plug it to income tax expense. I do want to point out just this last point that this is introduction to income tax accounting. So right now we're saying you plug it to tax expense, but when you really get into tax accounting, that is not always the case. So I don't want you to think this is the the law 100% of the time. There are different types of temporary differences, and if you recall, the temporary differences are just the differences between the income or expenses recorded for financial reporting versus the tax return, but they're just reported on different periods, or there might be different amounts in the current period between books and tax, But at the end of the day, after, a certain number of periods that you have to recognize that income or expense, it'll be the same at the end. So they're just temporary differences. It's not whether the income is taxable or deductible, it's just a matter of when. And there's 4 different types, and I'm not going to go through everything in this slide because now we have 4 different videos dedicated to each one of the, I have a video dedicated to each one of these boxes. The first one is an expense related deferred tax liability. These are items that are deductible for tax purposes now, meaning in the current period, but they're expensed for GAAP later. And when we say GAAP, that's our financial reporting, right? That's what we see on our 10K. So, and that results in a deferred tax liability because we're accelerating our deductions into the current period, which means we won't get them in the future, and it will result in future taxable amount. If you look at the introduction to accounting video, you'll see an example of depreciation. And let me just go, another example of this expense-related deferred tax liability is prepaid expense. When we as a company prepay expense, let's just say we have prepaid rent, we would debit prepaid rent, let's just say for $1,000, and credit cash for $1,000. For financial reporting purposes, there's no expense on the income statement for this item. Let's just pretend we did this on 12/31/X1. And so for financial reporting, the expense will come later, right? It'll come in X2, X3, or whatever, however long this rent is for. But for tax purposes, we are going to take that deduction now. We're actually going to reduce our taxable income by $1,000. Think of taxes, it's kind of a hybrid between the accrual basis and cash basis. Let's go through an example. Watson Associates purchased $60,000 of equipment in early January of 2027. Watson estimates the equipment has a useful life of 3 years and depreciates a straight line with $20,000 of depreciation through each of those years, 2027 through 2029. However, the tax rules allow Watson to take the entire $60,000 deduction for the cost of the equipment on its 2027 tax return. So we have an asset that's being deducted over 3 years for financial reporting, but can be actually the full 60,000 can be deducted on the 2027 tax return. And Watson has a 25% tax rate and pre-tax accounting income of $100,000 in each of those years. So when it says pre-tax, I want to kind of highlight this right here. This is the pre-tax that they're talking about is $100,000 per year. So this pre-tax is after the this is the financial reporting pre-tax accounting income. This is after depreciation, after we've taken our book depreciation. So when you look at, if you look at here, we have accounting income before depreciation would have been $120,000 each year. And then it tells us that we took $20,000 depreciation. It shouldn't really be like this. So, which is how we get to $100,000 of pre-tax accounting. Now, when you see problems, they might give you pre-tax and they'll give you the information so you know what the accounting income before depreciation is and what the depreciation expense is, but they might just give you this piece of information, which is what this problem did, but I just want to, I drew this out so you can see how that works. Okay, so this is the same thing. So now we're going to start with the pre-tax accounting income. That's how we always start to calculate our taxable income. We always start with a pre-tax book income or accounting income, okay? And what we're going to do is, let's just focus on 2027 right now. We're going to add back the depreciation expense that was taken for financial reporting purposes, right? So if I go back here and erase some of this, we started with 120, we took out we reduced it by 20 to get to 100. So we're going to reverse that 20. We're going to add back that 20,000. So if you think about it, this now becomes our pre-tax before book depreciation income of 120. And then I'm just going to draw that again. And then we're going to take our depreciation deduction on the tax return, okay, which we said can all be taken in year one of 2027. So our net temporary difference is a net reduction of 40,000 because we added back 20 and we subtracted 60. In 2028, we just have to add back the 20,000 and we get no tax deduction because we've already taken all of that in 2027. So that gives us in 2027 our taxable income of 60,000, right? We start with our pre-tax of 100, add back the book depreciation, deduct the tax depreciation to get us a net temporary deduction of 40 to get to taxable income of 60. I want you to notice when we look at all three years, we've taken basically, we started with pre-tax book income of 300,000. And at the end of the 3 years, we end up with taxable income of 300,000. So we're getting taxed on the same amount. It's just a matter of different periods, right? We recognize $100 for books each year, but for tax, our taxable income is 60, 120, and 120. Now remember, these are just temporary differences, which is why this is happening. There are things called permanent differences, which are treated differently, but that's in a later video. Okay, so now here's our taxable income for the current year of 60,000, and we know that we're going to add back 20,000 of depreciation expense in each of the future years in 2028 and 2029. So in 2027, we had a net deduction of 40,000, right? And that's because we added back 20 and subtracted 60. And we know we're going to have to add back this full 20, right, in the next 2 years. Now, what we are going to do is we're going to tax affect our current, we're going to calculate our current payable first. Our step one is calculating our current income tax payable, which is our taxable income multiplied by our enacted tax rate, which we'll get to in a different video as well, gives us our tax payable of $15, okay? So we're going to credit income right here on our journal entry, right here. Oops. We're going to credit income tax payable. Step two is you're going to, here's step two in that 4-point steps. We're going to calculate our ending balance of our deferred tax asset or deferred tax liability. In this situation, we have a deferred tax liability because we know we're going to have a future taxable amount because we're going to have to add back $20 into our taxable income because we've already accelerated that depreciation. And remember, you always have to tax affect things. This is like probably the number one most common mistake students make is that they forget to tax affect all these things, okay? So we have from 2028 and 2029, we're going to add back $20 for each of those years, so $40 total, and we're going to tax affect it at the enacted tax rate of 25%, which gives us $10. So our ending deferred tax liability is $10. Our beginning deferred tax liability in this example is 0. So our total change is right here, is a credit to deferred tax liability of $10. And then our plug is going to be to income tax expense. We're going to debit it $25 because we have a credit to income tax payable for 15 and a credit deferred tax liability for 10. So our debit will be 25. Let's go into now the following year in 2028. Our pre-tax accounting income is $100. We know we're going to add back $20 of that depreciation because we already took it for tax purposes in 2027. So our taxable income in 2028 is $120. multiplied by the enacted tax rate gives us a $30 income tax payable. So step one, calculate your income tax payable. You're going to credit income tax payable for $30. Step two is figure out your ending deferred tax liability. Well, now I've already recognized this deferred tax liability basically in the current year. So now in the future, remember, deferred taxes is what happens in the future, not in the current period. So now I have one more year where I'm going to have to add back this $20 right into my taxable income. And that $20 multiplied by 25% gives me 5. So my ending deferred tax liability should only be $5. My beginning deferred tax liability from 2027 was $10, which means I debited deferred tax liability for $5 in 2028. So step 3 is you record the change in your between your beginning and ending deferred tax liability. So I have a debit to deferred tax liability for $5. And step 4 is my income tax expense, which will be a plug. So I'm going to debit income tax expense of $25 to make this entry balance. Let's finish this out by going to 2029. 2029, same thing. I have my $100 pre-tax income. I have to add back the 20 to get taxable income of $120. At 25%, my current income tax payable is $30. So step 1, record your taxes payable. So I'm going to credit income tax payable of $30. Step 2 is record your ending deferred tax liability. Well, now I have 0. Remember, we're just isolating this temporary difference related to this depreciation. I have no differences between my financial reporting and tax reporting in beyond 2029 because this is just a 3-year asset and we took the full depreciation for tax in year 1. So our ending deferred tax liability should be 0. So our beginning from 2028 is 5. 2029 the ending should be 0. So again, I'm going to debit my deferred tax liability for $5. So that's step 3, you record the change. And step 4 is, again, income tax expense is the plug of debit $25. So this is just kind of an overview of what happened in the deferred tax liability account over the 3 years for you to see in a T account format. Let's go through a concept check for at the beginning of 2027, Wyatt Company purchased equipment for $800. The equipment has a 4-year useful life and Wyatt uses straight line depreciation method. So a 4-year, $800 straight line method. Under the tax laws, Wyatt is able to fully depreciate the equipment for tax purposes in the year of purchase. Wyatt has a tax rate of 25%, and as a result of this transaction, Wyatt's tax expense journal entry would include what? So we have to figure out what the journal entry is to see which one of these is correct. So we're told that in 2027, because we're only looking at 2027, right? 2027, our income statement, when it says income statement, we mean our financial reporting income statement. We bought an asset for $800 and we're depreciating over 4 years straight line. So in our financial reporting income statement, we're going to see a $200 depreciation expense. For tax, we get to take that full amount in the current year of 2027, which results in, we've accelerated now $600 of depreciation into 2027 for tax return purposes, which means we're going to be taxed in the future on $600. And remember, always multiply it by the enacted tax rate, which is 25%. So we have this ending deferred tax liability of $150, and which means we've increased our deferred tax liability for $150 since this is just year 1. So we're going to have a credit to deferred tax liability for $150. Let's do one more concept check. Windsor Company started 2027 with a deferred tax liability of $150. So in this situation, we're given the beginning balance. As of the end of the period, Windsor identifies future taxable amounts of $800. Windsor has a tax rate of 25% and calculates the taxes payable will be $120. And Windsor's tax expense journal entry will include what? So this is a little situation is different. We're giving our deferred tax liability our beginning balance. We're told that there's some future taxable amounts for $800. In this situation, it doesn't matter what it's for. Future taxable amount means we have a deferred tax liability in the future, and it tells us what our tax payable is. So step one is always record your current income tax payable. So we're going to have a credit for $120. We're given that in the problem. Step two is figure out your ending deferred tax liability. So we're told that we have future taxable amounts of $800. Our enacted tax rate is 25%. So our ending deferred tax liability is going to be $200. We're also told that the beginning deferred tax liability is $150. So step three would be to calculate the change between the beginning and ending deferred tax liability, which is a credit to DTL to deferred tax liability for 50. So we're going to record this credit to deferred tax liability for 50. And step four is going to be the plug to income tax expense, which is $170 just to make a balance. So in this situation, B is the answer, debit to tax expense for $170.